Let's begin with the news of Trump's tweet and the decision to push back the March 1st deadline. What do you think this means for the dollar moving forward?
You know, it's interesting because the dollar reacted pretty quickly to it, as did the equity markets, and the dollar sold off a little bit. And I think part of the reason behind that, one of the things we step back and take a look at, is all of the economic data has been making its way through the currency markets in one way or another. So when we had the Fed pivot and become very cautious about raising interest rates, that generally would have been a decline for the dollar. But on the other side, the economic data has been a little bit weaker than expected, but in relationship to the rest of the world, the U.S. is one of the better looking houses on a lousy block. So we're kind of stuck in this range, and we've been here for the last 3-4 months now, going between 97, 95 or so on the dollar. If you just measure the volatility of those dollar moves, we're down near 1% or less for the last 6 months or so. So I think the next move could be a big one, and my guess is it may actually be a little bit lower as we see the trade talks heat up a little bit here, and we wind up with some better economic data from the global markets, maybe a little bit weaker from the U.S. So again, it comes down to the economics, and I think although we've been the better house on the block, I think that's going to shift here a little bit if a trade deal gets done.
Yeah, the driest towel on the rack, as I've been saying. Now that we've got some resolution here in terms of trade, Paul, does it allow us to focus more on the economic data and less on some of the headline distractions, more on the personal incomes and spendings, the GDPs, and some of the numbers that we know the Fed's dialed in on?
Yeah, it will eventually, because again, if we ink a deal today on trade, it's going to take at least 3-4 months for some of those data points to finally work their way through the economy. We're just now getting out from underneath the government shutdown numbers, and we should see some clean numbers starting in March for February. So it's going to take a while before we start to see some data numbers that really show the impact to trade, just as we see the trade numbers having a negative impact, and have had for the last 6-7 months or so as some of the sanctions have come in place.
So, Paul, is a more fair deal or an equally beneficial deal with China basically what the Trump administration is pushing for? Is this long-term dollar bullish?
You know, it's a tough question because, again, without knowing what the details are going to be, and it's really going to come down to technology and proprietary information, I think that's going to be the key point. I think if they miss that and they focus on soybeans and steel and some of the other issues, I think it's not going to be a great deal, and it'll be status quo, and we'll be importing a lot from China. As it stands right now, just looking at the last 6 months or so, we've imported a lot more from China, and our trade deficit actually has gotten worse. Part of the reason is because we are a big consumer of global goods. We're a very large economy and spend an awful lot. So it's going to be difficult, I think, to turn the trade numbers around. Without technology at the key, I think it's going to be a failed agreement.
Paul, what does all this mean for the Japanese yen, a currency which for the most part has been sidelined with all the trade talks? We've seen it benefit from weakness in the U.S. indices as the flight to quality play comes into or trade comes into play. But even with the indices coming off the decent lows, we've talked about the dollar near 2018 highs, but the yen has remained relatively lethargic. I mean, will the extended deadline bring energy back into the 6J?
I think temporarily it may. The Japanese yen has been struggling for a long time. You dial it out and take a look at a very long-term chart of the yen, and it hasn't been all that great. You take a look at what the Central Bank of Japan has been doing. They continue to be in their quantitative easing phase. They're struggling to get their economy moving much above 1%. They have a lot of structural issues with an aging population. So I think inherently over the long term, trade deal or no, I think the Japanese yen is going to be struggling mainly because of the structural problems that the Japanese economy has right now. It's going to be very difficult to get their economy going much above 1%. So I think the Japanese yen longer term actually is destined to go lower.
Yeah, Paul, real quick, another economy that's been kind of struggling a little bit has been the 6E, the euro currency, as the EU's been struggling. In addition to the weak economic data that we've seen, they still have yet to negotiate a trade deal with the U.S. As the indices, or as this plays out, I'm curious the type of impact that this could have on the euro currency, the indices here in the U.S. I mean, ultimately, I'm wondering, are we just about to shift our focus from China to the EU?
It could be the case, and I think too the EU is suffering. You know, as we mentioned earlier, the economic data out of Europe is very weak, near recessionary levels in some countries, and continued discussion about maybe cutting rates or extending QE is now coming up as a discussion point with Draghi. So I think we're going to be talking about a weaker euro and a weaker European economy, and I think that's going to be the case for a while yet.